Welcome to Money on Tap. Money on Tap, your personal finance headquarters, where we bring out the professionals' experience and some fun in what we call three-dimensional investing, utilizing insurance, brokerage, and fee-based planning. That's what we do on this show. We look at all sides of the issues, and we bring a fully independent planning perspective to the table.
Welcome back. You're listening to Money on Tap. I'm Ben Brayshaw, joined here once again with Dan Mickelon. How you doing, Dan?
I'm doing very well. How you doing, Ben?
I'm doing pretty good today. My voice is starting to come back a little bit, as you can tell, but still getting through that. I don't know why. That's probably a benefit to everybody. But we're going to work through this show. Appreciate all our listeners. If you have any questions, you can reach us at 855-226-8551 or email us at info@yourmoneyontap.com. We truly believe it's about your money, and that's what this show is about, is to try to help you make more money. There's a lot going on in the world around us, Dan.
It really is. It gets more complicated by the second.
I mean, we were waiting to do this show based on news that was popping out. I mean, so there's a lot of things that are happening around us, and we're trying to give you an informative approach. We do planning. We're both partners and planners at Brayshaw Financial Group. This is what we do. We do it day in and day out, and we love what we do. I love what I do.
It certainly never gets boring, that's for sure.
No.
This day by day, hour by hour, and it seems like minute by minute, there's just something happening that warrants attention and consideration, and it's just amazing how fast information flies these days.
Oh, I know. 50 years ago, they had the Bloomberg box, sitting in, and brokers would be standing over the thing, waiting for it to print its reports, and and everyone was anxious to get the news, and then it would be disseminated through the newspapers over the next few days. So if you were the broker that had the news, you were well ahead of the curve. Now, we have clients who know stuff before we do sometimes. I mean, it's a company they're associated with, know of, heard of, friend is talking about it. It's like, wow, that's impressive. So we're always trying to stay on top of the news here. So, but today, massive conversation that we've had about inflation. We've done a number of shows on inflation. It's definitely a topic. It's the other tax, as I would call it. There's tax, and then there's the inflation tax, and there's so much about it. And how do you maneuver your portfolios through it? We've done shows. We've talked about investment strategies and so forth. And today we're going to talk about investment sectors that the world is talking about, people are talking about, that can benefit you during an inflationary time. The Fed's obviously made its rate change. We're going to talk about that here in a second. More to come, according to them as well. But it doesn't seem to be impacting inflation.
No, not yet. That's the hope, is that eventually this has the intended effect. But, there's plenty of reason to question and have confidence or lack confidence in what's going on here.
Yeah, it's shocking how little confidence I have in pretty much everybody in the general leadership realm. But that being said, helping you find a way out of this mess, or helping you as a listener to find your way out of an investment mess, because you're looking to try to figure out, what are a lot of the experts out there looking at? What sectors are they considering? We like to bring a lot of exposure, because we've talked about everything from commodities to you name it. So it's been a big conversation there. But there's about 4 sectors I think we're going to talk about today, and give you some real food for thought, per se. But before we get right into that, we have for you Money in the News.
So first up, we got here from Fox News, Fox Business. That's an article from Daniela Genovese. Back-to-school retail spending expected to grow, with department stores making a comeback. This I found to be interesting, because you think in general, in times of high inflation like we're experiencing, that consumer spending, discretionary spending in particular, is one of the first to suffer. But the indications are they're seeing kind of the opposite of that they have an expectation that the back-to-school season will be stronger than usual. And sales are actually expected to be up 18.3% compared to the pre-pandemic levels, which is, I think, astounding. And another stat that was here in the article that was, I think, even as interesting or maybe even more, but 89% of that is going to be done online, which is incredible.
Yeah, it's pretty shocking.
Or excuse me, an 89% increase of online sales from the pre-pandemic days.
Yes. Yeah, that's correct. And so it's just interesting to me that, the world has really embraced that, and that is kind of a moving forward trend. I think it's always been a moving forward trend. I think the pandemic just kind of expedited a decade worth of online traffic purchasing. I mean, every person, every age bracket knows how to buy something online pretty much right now.
But absolutely did compress that time for sure.
Yeah. I got to be honest with you. It's easier. It's just easier. It's easier to pay somebody more money. It's less time. I don't have to drive there, find out they don't have the product. It's easier. But I think the article, as you say, Dan, it is one of those things that is a catapult to understanding, how spending looks like or how people feel about spending for the holiday season.
Yeah, and I think one of the things that it does demonstrate too, that there's so much cash pushed into the economy and the consumer wallet, even with these difficult conditions we face with the high inflation, the high price of gas, it hasn't really hurt the retail market just yet.
Nope, not yet. Not yet. Inflation hurts, but people are still buying what they need because they have the cash to do it. That's what's driving the inflation. If you got money to spend, you're going to spend it.
Yeah, I think what that points to here for kind of the investment side of this story is that, there may still be some opportunities in retail. The Walmarts, the Targets of the world, Macy's, places where back-to-school shopping tends to occur. They're all looking at, a robust period of time here. They're expecting some big sales, which is something to keep an eye on. And one of the other mentions in the article is that the back-to-school season is often a precursor for the holiday spending season.
Right.
So maybe that cash runs dry in between here and there, or maybe there's some kind of significant effect of inflation setting into people's mindset. But history has told us that a strong season in the back-to-school time will be strong in come holidays times as well.
Well, and I think, Dan, because they're talking about MasterCard spending, this is the company they're using to track this data. And it's interesting because from an investment perspective, I'm looking at inflation. And if you can't afford to pay for it anymore, guess what? It sits on the MasterCard.
Right.
Yeah.
And
so when things become too expensive and you're just used to buying and you just buy, that becomes a pretty big deficit pretty quick.
Well, with credit card rates at 20% now, we'll see where those go.
Oh gosh, I don't want to talk about that.
So next up, we have an article here from Market Watch. This is from Artarthi Swamithan. I killed that.
I think you got it right on, Dan.
Apologies. It's now more expensive to own a home than to rent one at any time since 2000. Here's what that means for house prices. This I thought was interesting because, everything in the real estate world has just been red hot. People are buying. Prices have been climbing, pretty consistently here for a good long stretch, although this just recently started to see a little bit of softness in that. But, what the article states, and I think it's lending itself towards the increase in mortgage rates, but for the first time in 20-some-odd years, it's more expensive to own than to rent. Yeah,
this is a big change in the shift of our economy, just in the idea that, there's just so, honestly, when I start thinking about owning versus renting and all the different moving parts here, right? We just had a pandemic and we're 2 years coming out of this thing and the world is starting to open up, and I would call it open. But people have gotten scared by that. They don't ever want to be caught in that scenario ever again. So there is value to owning a property because, you just want space. You don't want to be stuck in an apartment in the city. So, there's all these second homes being purchased all over, almost irrelevant of where it is, as long as you can go outside, use the barbecue, and have a yard. Like that's like A, B, and C. The other thing is, we're fortunate enough to be in the state of New Hampshire, which has a massive amount of influx of people coming in because it's the more conservative state in New England. So anybody moving to New Hampshire, please vote conservative because that's how we got where we're at. And, the thing about all of this is that, there's no houses really. There's very few. The amount of houses on the market right now in New Hampshire is at its lowest almost ever right now. Like it's at the bottom barrel. And I was shocked because I was talking to a realtor friend of mine the other day, and he goes, I totally agree with you. Rates going up and everything else and making houses more expensive, going to deflate real estate. Absolutely. But not here in New Hampshire for a long time.
Interesting.
And I said, really? He goes, yeah. He said, there's so much interest from out of state all over the country for New Hampshire. It's just astronomical. And the money, he said, most of the buyers are cash. So he said to me, he goes, we might have, had 60 showings and 30 offers on a property. Now rates have gone up pretty considerably, and we're now at like 30 showings, and we're looking at 12 offers, all over asking.
Wow.
So he's like, I got to be honest with you. I know it's going to slow it down a little bit, but we still don't even have – he's like, we're selling the worst of the worst. Like the nice homes go faster, and they still have as much attraction as before. So it's really very interesting in that perspective. But this article is really fantastic, I think, because it makes a really good point because of the average median is like, hey, nationwide. But I was talking with him, and we were just chatting about it. He's like, yeah, we're hearing similar, Utah, Montana, like all these states who have land focused, that are not highly populated downtown cities, people are looking for second homes.
Yeah, I know this is just driving home from lunch today, or back to the office rather. The fourth house on my street just went up for sale like in the last 2 months.
Yeah,
and it's it's incredible. They're just popping up all around. But I think what the article's lending to is that according to the statistics and their
you sure that's not because you're on the street, right, Dan?
I could be scaring them off.
Could be.
But that's
pushing them out.
I've got a little overzealous with my chipmunk count, But
yeah.
They say it costs $839 more per month to own than to rent.
And this is a quote, and that is a quote in this article from another blog by a gentleman by the name of John Burns, who does a really good, interesting comparison. And he has a chart here. It's phenomenal. It talks about, interest and rates and down payments and the cost of maintenance and all the different historical averages and so forth. And so when you really think about it, it's like $850 more a month. It's like, that's a ton of money. And there's some real valuable evidence there that it is more expensive. But I think we can make this simple point because this article talks about a house in April of 2022, that owning a house in April of 2022 would cost you $2,114 a month, where if you bought a home, rented a home, it would be $1,962. So meanwhile, owning the house was $152 more. But that's not maintenance. That's not interest and insurance and all the different things you have, all this other stuff like this breaks, that breaks. When you rent, you're just done. And I think, Dan, we were chatting about how many people are probably thinking about there's not much on the market here. Let's sell our house and go rent something cheaper.
I haven't heard that, as frequently as I do now in a long time, where people that looking at substantial gains in the home they own, maybe looking to downsize anyway, but there's no compelling reason to rush into that next property because they know they're paying at an all-time high. So more people than I'm used to hearing are willing to sell and rent and just kind of sit out the market and then jump back in when they think opportunity is best.
Yeah, very, very interesting. Typical home value, according to Zillow, May 31st of this year was $350,000. 2 years ago, it was $251,000. It's $100,000 more. So separate from all of that, just the inflation on real estate from demand alone. Think about how far we have to come back.
So you got to spend $100,000 more, almost a third, and you're going to pay double the mortgage rate to get there.
It's crazy. It really is crazy. I honestly, and we've mentioned it before, I think people are going to subside themselves to, I love my house. I need to because the rate's so low from when I financed it 5 years ago or 3 years ago that I'm here for the long haul. Let me go to Home Depot or Lowe's or whatever. And I think we're going to see a lot of fix it yourself kind of stuff be done. I think those type of chain stores are going to boom because of this stuff, because people are going to say, I'm fixing what I've got. I'm not going to go buy something that I don't have to worry about.
Yeah, and the other thing is the market could soon, I don't have any statistics around that, but I'm thinking as we're discussing, people who invested in second and third homes, the Airbnb rental style that did it with an arm,
yeah,
they're going to be neck deep and underwater here shortly. So there might be some opportunity popping up in that market.
And I think we probably exclude everything in Florida in this conversation.
That's right.
The final article we have here ties right into the inflationary conversation we're going to have today. And that's that the Fed just raised rates 0.75 of a point, 75 basis points. So everything that we just talked about with real estate and the cost of homes, it all just went up in a heartbeat, literally. And so we have now just amplified the problem even more so. So the Fed has raised rates 75 basis points.
Which is the biggest increase since 94, by the way. They typically don't do that. And, kind of all along since the last increase, it's been forecast at 50 basis points. We just kept hearing that and hearing that and hearing that. And the market was not reacting well, is fair to say. It
was not reacting well, and the history behind a half a basis point was in the early 2000s. They had done quarter, and then they raised it a half a basis point. 50 basis points or 0.5%. And we went into sheer depression, recession. It was a massive, horrible experience in our market. And so them going all the way to 75 bips, all the way up to that number, was a big statement. The other big statement I heard today, well, there was two things. They were talking about only raising it a half a point, and that was just kind of nudging on the idea of it. And I think they do this stuff intentionally. They want everyone to get comfortable with it. And then he came, Chairman Powell came out and said, last week, he was like, hey, looking at doing probably 75 basis points.
Yeah, I think it was pointed to July when he said that, but he kind of leaked it out. I think it was probably late Monday that, maybe this one will be 75 too. And people generally took it well. And, honestly, following the rate hike, we usually see the market tank. But today, it reacted very well to that. So I think there is some consensus beginning to form around the fact that, and this is just my interpretation of it, right, that the market thinks the biggest risk that we face is the continued inflation.
I agree. I would agree with that. I would agree with the fact that it was interesting, too, because Chairman Powell said that in July we're probably looking at another 75 basis points. So rates are going up, and they're not going to turn around and say, we did 75 and that worked great, guys. We're just going back to zero. That just doesn't work that way. So
no, I mean, in this year, we're going to go from 0 to probably the neighborhood of 3%.
Yeah.
That's aggressive.
And then on top of it, he said 50 last time and went to 75. Are they saying 75 and going to a point? Now, you're right. The market has responded favorably. But the scary part is when we come out with data next month, if it doesn't show any improvement, and inflation went up month to month. Like, we didn't see anything great. I mean, nothing, the response has not been what they wanted, which is why they're going to 75 bips. So that being said, my fear is we're spinning out of control, and the demand is so high, it's irrelevant of the cost because they have, people have fulfillment orders. People have obligations. Like, if you're in the middle of a building, it's like, hey, listen, whatever that steel costs, you got to send it to me because I'm under contract to finish this job. And I don't want to wait 6 months. Send it. I'll pay whatever I got to pay because these big corporations, they have fines and fees if they don't get stuff done on time.
Yeah, you don't want to go bankrupt sitting on your shovel. You got to do something.
Exactly. So I think there's a problem that we could go into hyperinflation just because interest rates are making everything more expensive on top of everything being more expensive because of demand. And that's a whole nother unquantifiable scenario.
I mean, it's yet to see what's going to happen, but I think it's fair to say the 75 basis points today is, that's kind of them breaking out the big guns. If this doesn't work, it's scary to consider what has to be next.
Exactly. That's exactly where I'm going. I mean, and they might say, hey, if this isn't working, are we going the wrong direction? Because the thing is they could be raising rates, making it worse. But should they be lowering rates, which sounds completely asinine in the idea of any economist out there. But the truth is do they need to lower rates to build infrastructure to get the product on the shelf to lower the cost so that they have oversupply?
Yeah, that's another fear that I've seen in the retail world is, there's been such barren shelves and this clamoring for product that people have ratcheted up their ordering in a time when inflation's run rampant, so the shelves will be stocked and everyone will be broke.
Yeah.
Then what do you do?
Exactly. There's 25 problems we could list out, the hypotheticals. But that's going to do it for us in Money in the News. Went a little bit long there, but I think it was really important stuff because we're going to be jumping into inflation, how to invest in sectors that benefit you from inflation and during inflation. So stick with us. We're excited. I'm excited about this show. There's some really good, interesting stuff in here that has, things that we're actually thinking about and have done investment-wise. So you can reach us at 855-226-8551 or email us at info@yourmoneyontap.com. Thanks so much, and we will be right back. Don't go anywhere.
Call us today at 855-226-8551. and get your free consultation with Ben Brayshaw or Seth Krussman or any one of our partners and find out what's going on in your plan, your estate plan, your financial plan, or what you're planning at all, if nothing. Get it fixed, get it right, get it done today. Give us a call at 855-226-8551.
Now back to Money on Tap with Ben and Dan.
Welcome back. You're listening to Money on Tap, and I'm Ben Brayshaw, joined here with Dan Michelon. We are talking today about investing in sectors that benefit you from inflation, and I think this is kind of where everyone wants to be. The Fed raised rates 0.75 of a point. The market's up, then it's horrifically down, and everyone's more than scared and wondering what's coming up next. And inflation is knocking at our door, and people are wondering where to put their money. And we are going to talk a little bit about that today, actually a lot about that today. And you can reach us at 855-226-8551 or email us at info@yourmoneyontap.com. We know a lot of people have questions. Specifically right now, people have questions, Dan, about their portfolios. You know, maybe you're sitting there, you've lost a lot of money, you're knocking on the door of retirement. You're wondering if there's solutions out there for you. We have a lot of shows about all sorts of different ways to mitigate and deal and address and still make retirement a reality for a lot of people. But today's show is about those people who are looking for a long-term hold, looking to, work their way out of this marketplace and, take the steps that they need to do to win in this race.
Yeah, it certainly doesn't seem, looking around, that there's really any steady ground to get a footing on. It seems like everything's down all at once, and it truly is, but that isn't going to be the way forever, and there certainly are opportunities to position yourself, best for now and even better for later when this thing finally does turn around.
Yeah, it's a scary time, and, if you bought into this market and you're running scared and you're afraid and you're selling or you're feeling uneasy, then what you own is probably not suitable for you. I mean, I think that's kind of the one piece. It's funny, the market crashed the day after the Fed raised the rates, right? And meanwhile, the one stock I can think of that was up that day was Walmart. But everyone was talking about how Walmart might not be a good own because of the cost of fuels and shipping and all of the needs to get the things back in through the stores. So complicated, very, very complicated. So what we're going to do today, we're going to talk about basically 4 sectors that have some attention by a number of analysts, and go through what they're talking about, why they're talking about it, and the various places that you can potentially look in a kind of a global scale, because picking stocks in a market like this right now is a scary time.
Yeah, it's very difficult to determine, ultimately what the winners are going to be. But for sure, at least historically speaking, there are certain industries and certain sectors that benefit from inflation or at least have the ability to sustain themselves through it and present opportunities for you to grow your portfolio. And I think that's what everybody's looking at right now is, hey, maybe you've taken a ride on some of the tech stuff that was doing really well through the pandemic times and is really suffering at this point. And you've seen those gains that you kind of booked, vanishing in front of your eyes. And the question is, well, what next? What do you do now?
Absolutely. Well, we have an article here that we kind of referenced in this piece, and it's mostly quoting a gentleman out of Money Wise, this Claudio Cesani. He's a veteran, and he talks a lot about inflation, and we've kind of worked through that piece in a couple areas. But the first area that he had mentioned was financials, and I think that's definitely been on our prime list. I mean, in an inflationary environment, the Fed is raising these rates, and there's a presumable spread between what the Fed lends the money out and then what the bank does. And as the rates get higher, the spread gets a little bit more generous. So, banks have kind of been waiting for this time. Remember, Dan, when we used to have bank accounts and you didn't have to pay any fees? They used to pay you interest on your checking account. Now you have to pay to have a checking account. And there was an actual real savings to savings accounts. And so banks have been waiting to get back to this space, and eventually banks will become competitive again in that space with higher rates.
Yeah, I mean, if you're leaving your money at a bank in a 0% account, I mean, you're losing against inflation. I think everybody can understand that as a basic tenet to this. But as the banks begin to offer rates for holding your money, that gap between how inflation is affecting your expenditures and how your savings are able to grow is going to tighten up. So that's a good environment for banks. Banks like to induce that inflow of cash, right? So they're able to bring in more money and pay a rate for it. So they're going to attract you to save with them by offering some interest. But the gap between what they need to pay you and ultimately what it costs them to borrow, widens. So they're able to benefit from that, and you can benefit from saving with the bank, or you can benefit from buying those financial stocks.
Right. And I mean, bank, loan rates, 30-year mortgage loan rates went over 6% last week for the first time in I don't know how many years, 15, 20 years, whatever it was. I remember my first time home buyer mortgage was like 6.25%, and everyone thought that was astronomically cheap because everyone else's loan rates were 8 and 9. So we're back to kind of this old school normal rate industry, and the Fed says we're not done raising rates. I'm a little concerned about that personally, and I think it might be a little bit too much too soon. Earlier in the show I had mentioned that there's a possibility that lowering rates could potentially be the way out, not raising rates. And I think it's funny, China actually just lowered their rates when everyone else is raising their rates. And I'm curious how that disparity is going to come into play. Yeah,
it'll be interesting to follow that and see if there's a real difference in how our economies behave as a result of what the Fed policy is in two different places. But one thing you got to watch out for, you mentioned mortgage rates. Financials represent a good opportunity, specifically banks, during times of inflation because they're able to profit from some of that spread. But one thing you do need to watch out for is if you're seeing in the news that default rates are really ticking up, mortgages and corporate loans and those types of things. Well, that's where financials will begin to suffer from this. So, there is the notion that they benefit from inflation to an extent, but when that inflation really gets out of control, and all their loans that are out there are going belly up, well, that's time to move on and find something else.
And what Dan's referring to is, some of these loans, traditional home buyer buys a 30-year mortgage or a 20-year mortgage, or it's a fixed rate. But on the commercial side, it's not fixed. It's fixed for a period of time, maybe 3 or 5 years, could be 10, but eventually it does fluctuate and it moves with the rate environment. And so if a business is running really well on one rate and it's not running well when the number triples, that's a problem, and that can cause it. And I know, a number of the financial companies that are mentioned by Chisani, and which are the dividend payers pretty much, which is like JP Morgan Chase, and most of the banks pay dividends, but Bank of America, Morgan Stanley, they're running right through Goldman Sachs. These are the big boys, and that's honestly a great point in the idea that a lot of people are flocking to banks. Wells Fargo being not on the list, but I think they're probably one of the banks most susceptible to kind of that default problem. I think their loans are more questionable or more struggled, potentially long term, and I've heard that from various reports. But you're right, Dan. This is a number one earmark for inflation is to run to banks because of that. But if it turns into hyperinflation, this is buyer beware.
Yeah, and I think the common theme you're going to see, throughout all these kind of inflationary opportunities is that, these are investments that do pay a dividend. So we've talked about that a bunch here, and if you're a regular listener, you've heard us speak to that point many times. But regardless of the price fluctuation, which is just going to happen, that's the market we're in, and that's how markets always behave, although it's just more volatile right now. But having an asset that pays you to own it makes the actual price of it less significant. It's not insignificant, just less significant, because you can wait it out as that asset is paying you to hold it.
Right, and just because something has a high yield or a high dividend, it's paying you regularly, doesn't mean it's even a very good company. You have to understand what it's paying you, why it's paying you. Some companies pay their dividends out of loans from the bank just to keep cash flow moving, and that's that for some people that's not an interest, and it's not one of mine necessarily either.
It's certainly not the only indicator you got to look at. Yeah, for sure.
Absolutely. So I think the one thing that I would break out here is that financials kind of encompasses the world of insurance, right? I mean, everybody is, it's like if you're a financial company, they just bulk you right in. If you're an insurance company too, hey, this is all the financial world. But I think the insurance in this scenario really needs to be broken out separately. I think when we break out insurance companies like MetLife or Prudential or Manulife or Jackson National or any of these different stock traded, they all pay pretty decent yields. They are interest rate sensitive, but they're not running these mortgages like everyone else is.
Yeah, there's certainly a difference there. You can choose, whether or not to buy a home, essentially, but you can't really choose whether you insure it, or you shouldn't choose not to insure it. So insurance companies, because they have a product offering that most people consider essential, business is going to come their way regardless of cost and environment, because to not insure your largest assets is just foolhardy. So they have a little bit more of a predictable inflow and revenue stream, and their market is less sensitive to some of the fluctuations that go on out there. So it is an opportunity to find some stability, potentially paying you a dividend that will perform even in high inflation.
Yeah, and the thing about insurance companies is that people need insurance. So you're insuring your house, you're insuring your car, you're buying life insurance. There's
medical insurance,
medical annuities, whatever kind of insurance that you might be. The engagement there is a completely different risk scenario than a Citibank, for instance, or
sure.
So as you're listening to us, we're not recommending any of these stocks, obviously directly or indirectly. Matter of fact, some of these stocks I wouldn't even buy, but there are things that come to mind. There are things that are being listed here in this article we're chatting about. And, as we go through this here at Money on Tap, and in Brayshaw Financial as planners, we try to understand where you need to be for the best cycle of the odds that present the best opportunity for success, because that's really what it's about. It's getting you from point A to point B. And honestly, when I look at the financial sector, and the reason we broke this out is because insurance is really probably the better of the two pieces, in my opinion, from a financial sector, disparity, which I think is interesting that he didn't break that out.
Yeah, I think part of the reason it's probably not pulled apart in the article itself is that the author is pointing to some ETFs that he likes, exchange traded funds, that he thinks will hold water and do well in this time. And the way those ETFs are comprised, that separation doesn't take place, right? So although they do exist separately, you can get true banking institution type funds versus insurance company type funds. That's just not what's referenced here in the article.
Yeah, and the various companies sell them, these ETFs. There's XLF comes to mind. That's the financial ETF. A lot of people are attracted to that kind of exposure. You get a number of exposures to 50 or 100 different financial stocks that manager finds valuable or potentially worth your money. The other area that I tend to agree with this gentleman on is the real estate investment trust space.
Yeah, and that's something that we bring up often is as an asset class, and the reason that we find value in it and we take opportunities to punch it into our portfolios is that it's that non-correlated asset, right? So it's real estate behaves differently than the stock market
itself. Break that out for us, Dan. What's non-correlated?
Yeah, it's real estate is not stock. So I probably can't.
But it is a stock. It is a stock.
It is a stock, but it's not stock, right? The real estate investment trusts and the real estate world in general, don't perform in line with the market. If you look at long-term charts of prices and values, they're just not connected, and that's the non-correlated part. In that, whatever is befalling the stock market as we speak, has yet to impact real estate in the same way. Now, the rising rates, and we've talked a little bit about home prices, potentially teetering and looking at a downturn for the first time in a long time. That's something to certainly consider. But REITs, much like the dividend-paying stocks we spoke about, pay you to own them, right? So even if the asset value, the share price, is diminished a little bit in the climate that we're in, they're going to continue to pay that dividend to you.
So as we're talking here about REITs are real estate investment trusts. They are stocks. They're traded on the exchange. There's a number of different companies that have them. There's actually ETFs of REITs as well. So you can buy a stock that is a REIT, or you can buy an ETF, which is a culmination of stocks that are REIT focused. And there's a number. Vanguard has VNQ. It's out there. It's mentioned here in this article. Which is an office properties program. That's another ETF scenario that they mentioned. So as you're kind of going through this, I mean, you can actually, in the real estate world, say, hey, I want this non-correlated, it doesn't really, it moves with the market because it's a market-based investment, but it's specifically focused on real estate, which if you think that's a good sector and you're not sure, like, hey, there's a lot of people who look at real estate and say, I would love to own real estate, but I can't, fix a sink or a pipe or electricity. I'm not the person who's going to own a 2-family, or, I don't know how to own an office building. It's not anything I'm capable of. Well, if you feel like it's a sector you should be connected with in the middle of an inflationary environment, there are ways to get exposure to specific types of sectors. I mean, there's even storage REITs, real estate programs out there where you can get exposure to storage units. I mean, you can get really specific or you can get very generic. And I like that about the REIT space quite a bit.
Yeah, I mean, we talked about money in the news. The cost of owning a home is, beginning to exceed the cost of renting for the first time in a while. So if you look at that as an indicator of, what the next 6 months, 6 years might look like, whatever the time frame is, you can get into a REIT that's specifically for residential rental only, and own that for as long as you like, and sell it and whenever you feel like it. Trades like a stock. You buy it today, sell it tomorrow. Easy enough.
Yeah, I mean, you look at that data, you says, well, man, that makes some sense. I mean, but how many people want to sell the house that they just bought, or start realizing, hey, rents are really getting much cheaper? Because when I was thinking about that, when we were talking about that in Money in the News, and I really didn't touch on that, but with inflation, all of the numbers that he was adding on to the cost of maintaining your own home are based on a pre-inflationary environment. So as we move forward, right, your rent might be locked in with a fixed rate of increase for the next 3, 4, 5 years. Who knows how long you've signed up for? And yet, if you own a house, you're tied to whatever inflationary environment we're in.
Yeah, whatever repair work you need to do, it's going to cost what it costs.
Might not be $800; it might be $1,000 more to own a house versus rent a property moving forward. So there's a lot to that. Man, I mean, as we go through these sectors, and as we talk about, finding ones that can really combat inflation, understand that there's so much more to this conversation out there. We're trying to kind of bring you the forefront of what a number of people are talking about. We're talking about Chisani. He's a well-known, financial expert out there. And, it's nice to bring people in that perspective to the table. But probably, and what we're going to jump into here in a minute, and I'm going to take a quick break, is the commodity space and some of that and what that really brings, and how to get exposure to that in a lot of different interesting ways. Because in the commodity space, you can get as much burned as you can ride with inflation. And I think that's one of the concerns a lot of people have when you're listening to the opportunities that are out there. You're listening to Money on Tap. We're going to be right back. You can reach us at 855-226-8551. You can also email us at info@yourmoneyontap.com. We know there's a lot of people out there scared. We know there's a lot of people out there trying to figure out what the next steps are. This market's crazy. NASDAQ's down 35% from its all-time high. People are really losing their shirts. There's a little bit of 2008, 2009 conversation out there, and people think there might not be a solution, or I don't want to jump. I don't want to lose. I don't want to make those moves. But there are answers out there, and I would encourage you to reach out to us, 855-226-8551. We will be right back.
Hey folks, Seth Krussman, Brayshaw Financial Group is our company, and we bring to you Money on Tap. I say we, that's Ben and I. We have a lot of fun doing this show. And one of the things that we love about doing Money on Tap is that our goal for you to have access to the financial planning world. How do we think? What are we doing? What are we talking about? Raising the bar of your financial education. It's so critical. And that's what we're doing here. The other side of this is as well, we're financial planners. if you are looking to work with a financial planner, if you want to have that playbook for you to understand the important things right now and how you're going to get to your goals or how you're going to retire successfully, that's what we're doing as well. If you have $250,000 of investable assets, give us a call. It's free to you, and it is worth your time to pick up that phone and give us a call and discover what complete wealth management looks like. Ben and I are excited about the opportunity to partner with you and give you that financial plan that's going to make the next step so much better understood and get you where you need to go.
Now back to Money on Tap with Ben and Dan.
Welcome back. You're listening to Money on Tap. I'm Ben Brayshaw. Here with Dan Michelon, we are talking about investing in sectors that benefit you during inflation and inflationary times. There's some crazy stuff going on in this market, and there's a lot of people that are very, very concerned. And they're not sure that we've seen the bottom after a 35% drop on the NASDAQ's all-time high. I mean, people say, well, why is the NASDAQ getting hit so hard? And honestly, it's because the tech sector borrows the most money to develop themselves. So there's a lot to that space. It directly correlates to those rates pretty earnestly. So a drastic raise is a pretty expected drop in the tech world. But, what do you do? Where do you invest? How do you try to find the best place for your money? And we've chatted a little bit about financials. We've talked about insurance companies. We've talked about real estate and how to get exposure in that inside the market and to move. And if you look at days like the day, after the Fed raised by 75 basis points here recently, you look at that and you say to yourself, wow, look at tech. It dropped 7, 8, 10, whatever percent. Oh, but the real estate space was hit just lightly. Walmart was up 1%. You start looking at these different places and you start saying, wow, in an inflationary time, these are what are seeing the biggest hit. But what's interesting is what I saw as a big hit recently was in some of the commodity space, and that's actually the next topic we're running into, Dan.
Yeah, commodities are, the things we need. They're the raw materials that people live on and industries build themselves with. So, the demand for commodities in general will never go away because, like I said, these are the materials that we all need, but they do move pretty drastically price-wise. So it is considered to be a bit of a risky investment in that, it's more volatile than a blue chip stock portfolio would be, for instance. But in days like this, times like this, when everything seems to be in short supply, it's probably a pretty good bet because this is one of the industries that, when you're selling a product that people just got to have, they're able to pass through that inflation cost to the consumer ultimately. So there are different industries that are less sensitive to what's going on in the rate world, and commodities typically has been one of those.
Yeah, commodities is kind of like the old school. I think of the word commodities, and the only the thing that comes to mind all the time is that old movie back in the 80s with Eddie Murphy and Dan Aykroyd. It was Trading Places. Yeah. And they're trading, they're in the garage and they're trading, I don't know, orange futures or something like that, And so it seems like the stuffy investment. I mean, I think that's what people, when people hear commodities, they're like, oh, we're trading oil futures or whatever. That's not what we're talking about. There's just so many different places in the commodity space, and oil is obviously one of those areas. But as you're kind of getting into it, some of the commodities are things as simple as the minerals around us. It could be gold. And, it's funny, but gold did go down.
Yeah.
Right? And so that's kind of a scary – and the one place you're going to go for inflation actually got hit pretty hard. But when you start looking at some of the, metals and minerals and things like that, I find this area pretty darn attractive in a lot of different ways and for more reasons than one. One of the areas I find is the mineral and metal space, just the amount of need for circuit boards. I mean, the silver and the gold and the platinum and the, all the different things that they need to make all of this technology that our world is becoming more and more dependent on each and every day. And on top of it, some of those metals and minerals are tremendously valuable and have an intrinsic value in society alone that we use every day. You know, gold has value. Silver has value. I think it's funny because AMC, the movie company, right? What did they go out with all the cash they took in from selling their stock when the Reddit guys were going crazy? They bought a gold mine. A gold mine. Yeah. They bought a gold mine. The movie company bought a gold mine. We did a Money on Tap thing about that. But I do think that there's some real intrinsic value there because 20 years ago, people bought gold just because of inflation. You know, they didn't really buy it for the technology place it has. But people harvest cell phones for the gold inside of them.
Yeah, it's been the historic hedge of all hedges, right? Gold is where you went when things were turbulent. That's kind of always been the standard. Although now it's down a little bit. It's just not suffering like the rest of the market is and a lot of other sectors. But, commodities has just been a place to turn when everything else seems a little bit out of whack because we're still going to need lumber. We're still going to need corn, soy. All the different things that are out there that feed us and are the components of everything we build. You know, that stuff is going to continue to move forward and the need will always be there. Especially now we talk about this pent-up supply issue, virtually all industries. And I think you just mentioned chips, right? You could sell chips for the next 10 years and never run out. Run out of demand for them. Anyway.
And we're not talking about Doritos. These microchips are...
Correct. Yeah, good clarification there. Yeah.
They're not... these cars have thousands of chips in them. Thousands. It's not like 500 or 200 or 4. It's thousands. For every little thing, there's a chip. It's crazy. And so there's a lot to this space. And one of the ETFs, XLB, which is a materials ETF, it's just kind of interesting as you're kind of going through these different, but I really do like the metals and the mineral space a lot. I think it's more interesting than probably the oil play, which is probably the number one inflationary thing. Matter of fact, there was an article we have here from Wells Fargo, Matt Krantz, who said that, historically, oil does the absolute best during an inflationary period.
Yeah, since 2000, during times of inflation, the oil's averaged or oil's return over that time has been 41%. And in this particular period, the last year, oil's actually been up 89%. So significantly, higher return than what history supports. But that has a lot to do with, obviously what's going on in Russia and Ukraine there because there's been a major hit to the supply end of things. But
just amplified by the overall craziness of the environment, the society, the conditions. Yeah.
All the oil companies are responding to the congressional inquiries and all this, saying, well, they had to ramp down supply when we went through the pandemic because nobody was driving, nobody was going anywhere, nobody was flying. And now it's just harder for them to ramp back up to meet the need that we have that's been created by, geopolitical issues. And, it's a challenge for them. It's a challenge for everybody. But the price at the pump does not seem to be, abiding too much here. I've seen a little bit of a dip locally, but nationally I don't think that's the case.
I didn't notice a dip.
Yeah, just barely.
I don't know which. I got to find out.
Went from a 10 to a 9.5 on the pain scale.
I'd prefer the amputation. So, it's interesting, Dan. To carry out this article, and we're going to take a quick break here and bring one last piece to the table. But I thought it was interesting because some of these sectors that they talk about as number two. So the second area behind the best inflationary investment of oil, which I thought was going to be gold, was not.
No. According to this, it was emerging markets,
which is down 22%.
Yeah. So I think
in the last year,
some of the concern with what we're facing right now is that a little bit of what's gone on in the past or what history would guide us to do isn't playing out the same way right now.
Yeah, and I just I speculate, and I wouldn't. You and I were talking about this. I wouldn't probably go throw my money in emerging markets today. That's not where I'm going. But I do think it's pretty interesting because there might be a point in time where we do kind of start cresting the bottom of this inflationary environment, and emerging markets is a trailer on this event. And that could be something to consider in the future. You're listening to Money on Tap. We're talking about how to invest in sectors that benefit from inflation. I'm Ben Brayshaw, joined here with Dan Mickelon today. You can reach us at 855-226-8551. If you think there's no way to get out of the hole you're in, there is. Give us a call. I'd love to talk to you. You can also email us at info@yourmoneyontap.com. We're going to be right back. We're going to close out the show with some more really valuable information for you.
If you're listening today and, your questions are outside the box of estate planning or financial planning or any number of the pieces that we kind of traditionally talk about, don't forget that Brayshaw Financial offers auto, home, and business insurance. And we have an entire department that handles all of that for you. Give us a call at 855-226-8551 and be happy to take care of those needs for you. Or email us at info@yourmoneyontap.com.
Now back to Money on Tap with Ben and Dan.
Welcome back. You're listening to Money on Tap. I'm Ben Brayshaw, joined here with Dan Mickelon. We've been talking about investing in sectors that benefit you for inflation potentially, and there's just a lot here. We've talked about financials. We've talked about insurance. We've talked about real estate. We've talked about commodities. Yeah, we've talked about a lot of things here. We're going to wrap this up with probably the fifth area that we think has some real potential for a long-term inflationary environment issue from a lot of different reasons and for a lot of reasons alone. One of the things, Dan, is the healthcare sector. And I think a lot of people overlook healthcare for a lot of reasons. Matter of fact, was not even covered in that article. And this is kind of one of the things that we wanted to bring to the table from a standpoint that's just kind of being overlooked. Because the thing about healthcare is we've got 320 million Americans. I've talked about this a ton of times on the show. And there's certain demands and needs that 320 million Americans have, but it's all based on the demographics of the population. And with 40 to 50 million Americans retired and another 70 or 80 million Americans going to retire in the next 20 years, we're talking about 120 million or north of 35% of our population all retired. And the one thing that I know I need as I get older every day, besides more vitamins, is I know that my health care needs are going to change. They're going to be more. They're going to elevate. And, 20 years and 40 years from now, if I ever make it that far, will also be growing astronomically. So not only is the population just aging right out of the workforce, and they're aging at a level that no one can quantify, and we've never seen before in America. I mean, 2007, we had the highest retirement rate in history for the first time. That was 5%, and we're going all the way to 35% of people retired. We've never seen this before. We don't even know what this looks like. The world has no idea. But we all know they need a ton of health care. And we all know it's going to get paid. And we know that every ounce of every piece of equipment that inflates, that costs more money, is going to get paid for throughout all of this.
It's another one of those got-to-have-it industries, right? I mean, people are going to, when they're sick or not feeling well, just going through aging issues, they're going to go see medical professionals. They'll be in facilities, they'll be taking medicine, they'll be going through batteries of tests, and all of that stuff, just pans out for the hospitals and ends up being revenue to them that is just guaranteed to be there. Yeah.
I mean, this is a you got 10 years to sit around no matter what goes on. I mean, the demand, the number of customers is just rising dramatically. Every day it's becoming more and more. And so knowing that and knowing that there's an end user and there's an end provider, hey, listen, these match up every day. We don't have a problem creating the need. It exists. It's naturally developed. I love healthcare. I think it's great. I mean, it might not have hit bottom. It might not be the perfect buy right now, but the shift to healthcare in lots of different ways, whether you're looking at medical device companies or you're looking at just straight up hospitals or insurers or whatever, there's a lot of different ways to get exposure to the healthcare space. But
if this volatility has kind of scared you off of the trading model and you're looking more for the buy and hold type of investment strategy, it's a good place to look at.
Yeah. So That's going to do it for us here today, this week at Money on Tap. We appreciate your time, and we're so glad to have you join us. We look forward to talking with you next week. And if you have questions, you know how to reach us, 855-226-8551, or email us at info@yourmoneyontap.com. Thank you so much on behalf of all of us. We look forward to working with you next week. Have a good one.
The views expressed are not necessarily the opinion of this radio station and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Investing is subject to risks, including loss of principal invested. No strategy, product, material, or tool mentioned can assure a profit or protect against loss. Please note that individual situations can vary. Therefore, the information, products, materials, or tools mentioned should be relied upon when coordinated with individual professional advice. Past performance is not a guarantee of future results. This show may be subsidized in whole or in part by a product sponsor or issuer. Securities and advisory services offered through SagePoint Financial Incorporated, member FINRA SIPC, and a registered investment advisor. All other services offered through Brayshaw Financial Group LLC are independent of SagePoint Financial. SagePoint Financial and Brayshaw Financial Group do not provide tax or legal advice. Main office is located at 116 South River Road, Bedford, New Hampshire, 03110, and can be reached at toll-free 855-226-8551.